back to the Everyday Growth Advisors, where we learn, compound, and grow. We are on to the technical analysis series, and we had covered the fundamental analysis series in the previous video. If you haven't already seen that video, I would suggest to go back and watch that one before you start this one, because it's all going to flow into a nice little compilation. So today we're going to go through a very interesting topic, and I can't wait to show you what I've been working on. I know it's been a little bit of time before I kind of uploaded the last video, but I bet and I can guarantee you that it's going to be worth it. I've been working on a lot of new content for you guys, and those kinds of things take time, so I hope that this kind of things are going to help you guys to learn, compound, and grow. So without further ado, let's get it. So today we're going to start the technical analysis series, which is going to cover 5 major topics. The first being candlestick analysis, moving to moving averages, support and resistance, trend analysis, and finally wave analysis. And today we're going to go through my favorite, candlestick analysis. So what do you need to know about candlesticks as a trader, and why are they important, right? I'm sure you asked yourself many times. Candlesticks are actually the building block of a chart. So if you know how to read candlesticks, you will know how to do a plethora of different things. And what are those different things? Well, candlesticks were firstly used to tell price action. In fact, it was used by Japanese farmers to kind of track the price of rice back in the day. Yeah, that's super old, but now we use it to track stocks and financial instruments. And in today's context, we use it to track past prices and also visualize supply and demand. So when you buy and sell something, that kind of gets sent to the broker. The broker sends it to a clearinghouse. The clearinghouse executes the order, the supply meets the demand, and boom, that appears on the chart. So that's the basics of how candlesticks are formed when you look at them on your chart. And we use them for technical analysis, which I must say right now with a big caveat. Technical analysis is a 70% indicator for all price action. So you have to take it, yes, you could take it pretty seriously, but I wouldn't rely your entire analysis on technical analysis. In fact, I go by a 60-40, where I use 60% of my analysis on fundamentals and 40% on technicals to gain insight on my entries and exits of my positions. So candlesticks, they accurately indicate price patterns and trend reversals, which are super important when you're doing a chart analysis. And even though you can't use it as a 100% indicator for market conditions, we can use it as a good way to track the condition of the market, supply and demand, and momentum and emotion, which is super important because you can track the price action and how it moves, and that gives you great insight on the market condition. Now, I know that the past is no good to predict the future, and none of us are fortune tellers. We don't have a crystal ball in front of us to tell us what's going to happen. But sometimes what has happened in the past happens in the future. And that, my friends, is the reason why we must learn this art in order to increase our probabilities of success. So let's get right into it. These are the basics of candlestick mechanics. And starting off, you got to know that there are 2 types of candles. There are the ones that are red and green, and then there are the ones that are black and white, which have either a white body or a black body. The white body is the green, and the black body is the red. They're basically the same, it's just that some people prefer red and green, and some people prefer looking at black and white. I honestly prefer the red and green because it helps me visualize things better. Green is bullish, and red is bearish. If you're wondering what bullish and bearish is, those are animal spirits that exist in our market. Bulls tend to push the price up, and bears tend to push the price down. That's just like the basics of it. And this is where candlestick analysis comes in. So if you're looking at a green candle, this is where the price opened up, and the price would basically go up to here, and this is where it would close, and that gives you the green body, which makes it the candlestick that it is. The inverse is true for the red candlestick. This is where it opens, and this is where it closes. The price goes that way. And these are the highs, and these are the lows. So whenever you hear this kind of jargon, highs and lows, and open and close, and this is called a wick, the things that are jutting out outside the candlesticks. Now, wicks are essentially the price action that has receded from the level which it was at. And the wicks terminology can be depicted like this. If there is a wick on the top of a candle, that means that the price was pushed down, which is bearish pressure. That means the price went downward. If there is a wick on the bottom, that means the price was pushed up, and that's bullish pressure. So depending on the time frame that you look at, these would all matter, okay? And just to get into a little bit of time frame, it really depends on what time frame analysis you do your candlestick analysis. So the basics of it go like this. If you are an intraday trader and you were, trading stocks on a daily, you're getting in a position in the morning, getting out, maybe within an hour, a couple of hours, you would use anything from a 1 minute to a 10-minute chart. And what that means is that every single candlestick in that chart would be 1 minute all the way to 10 minutes. So it could be a 1 minute chart, then every candlestick would be 1 minute. If it's a 10-minute chart, then all the candlesticks would be 10 minutes each. So different time frames give you a different chart, and different charts will tell you a different story. So if you're looking at it in a 1 minute chart, you're looking at the price action in a very short period of time, which would give you more price sensitivity, and the candle will fluctuate more. If you're looking at, for example, traders who use intraday trading, or if you decide to swing your position into the next day, then you would go from anywhere between 15 minutes to even 1 hour on the candles. And that's kind of like almost like a 2-day swing or something like that. If you were planning to go longer and you're looking at a perspective to swing for maybe a week or 2 or more, you would go, the 2 hours, 3 hours, 4 hours, and the daily. So if you're looking at a long-term perspective, you use a long-term candle time frame. And that's just basically how we do our analysis. If I want to recognize a pattern, I start with the big time frame, like the daily, and then I slowly zoom into the time frame that I want to trade. And that's how you kind of get an accurate sentiment on where things are going. Now, moving on. The basics of other kinds of candlesticks that you need to know. This right here is called the bullish Marubozu, which is a type of candlestick which shows that there is absolute bullish momentum in the market. And the reason why is because this doesn't have any wick. There is no price action that occurred from, a wick formation. So no price was pushed down or up. It opened here and went straight up and closed right here. There was no push down from bears. So this is a very, very bullish candle that shows that bulls are dominating. Oh, I completely murdered that. And the second one is a bearish Marubozu, which is also the same thing, except for it's a bearish candle. It's a red candle. So no wick on the top, and the price opened up here, and the price was driven down, and bulls didn't even contest it, so the candle closed there, and that shows that it's extremely with the bears dominating the price action. Now there's a third kind of candlestick which is called a doji, and the doji, it looks like a spinning top. There are many names for it. The spinning top is another name for it. And what this means is that the middle of the candle has a very, very thin body, but the top and the bottom have long wicks. And what does this mean? This usually means a market indecision of price action. So the top and the bottom would have, a very long wick that would push the price to the center, which would show that bulls and bears are in equal power and they're not able to reach a decision on the price action. So it shows an inconclusion between the price action. And basics of another aspect of candlesticks is the long body versus the short body. And the simple explanation is long bodies would have more price action, more volatility, depending on the time frame, and they could indicate either very strong or very active buying and selling. Versus the short body, which would show there's less volatility, less price action in that time frame. And so these are the building blocks that you need to learn. Now the next part is going to go into the types of patterns for candlesticks. I'm going to go through 2 patterns of single candlestick patterns, and then I'm going to make a second part of this video to go through the rest of them. So here's the singular chart candlestick patterns. The first one is going to be called the hammer and the hanging man. Yeah, we have names for all of these, and just to keep track of them and make it easier for you to remember, we give them names so that you can kind of understand what's going on. Now, with the hammer, you're looking at this kind of candlestick to appear after a downtrend. Now the downtrend, as you can see, is here. And once you see the hammer appear, which looks exactly like a hammer, you need to wait for a confirmation for the next candle, its body, to close above the high of the hammer. And you would take the entry right there with this candle right here. Once you can get an entry, you can confirm that this would be reversing out into an uptrend. So when you see the hammer, now I'm not saying that it's 100% certainty, but these things have almost like a 60 to 70% success rate. I've definitely traded the hammer candlestick pattern numerous times and it's worked out. Now the inverse pattern for the bearish side is called the hanging man. And the hanging man is the same candle as the hammer, except for it appears on the end of an uptrend. So this is the uptrend, and you would see that the hanging man appears right here. And then this hanging man will be followed by a very bearish candle, which is this one right here. Now once you get this bearish candle and it closes below the body of this hanging man, you can proceed to take your entry for the bearish case right there. And that would show the reversal going down that way, kind of this. So, you know, there are many ways you can look at this, and you know, there are famous candlestick patterns. So let's continue on here. The next one is going to be called the shooting star and the inverted hammer. So the inverted hammer is almost the same as the hammer, except for the wick is on the opposite side now. So instead of the hammer like you saw just now, which had this on this side, this actually has the body on the bottom, and it appears on the end of a downtrend. And once you see the inverted hammer, it's also a signal similar to the hammer. So basically any hammer kind of position, you're looking at a reversal, and that would mean that this price action is going to reverse up. And how do you know? It's simple, because this will close above. And yeah, so then the next one that you want to look for is called the shooting star, which appears on the end of an uptrend. And the shooting star is basically looks like this, and it will appear on the top. It indicates basically like you know, price action opening at a low, and then you would see people buying into a rally that causes the price to go up here, and then a kind of a sell-off, which would mean that bears are controlling this price action. So this often results in no buyers left, and then a downtrend like that. So you could trade this when you see the shooting star. The shooting star appears on the top, so it's easy to remember. The inverted hammer appears on the bottom. So stay tuned for part 2, where I'm going to get into the double and the triple candlestick patterns.